Now, as we turn to Europe and what is happening within some of the new data that's come out, it's important to weigh, there was some growth, but what is happening on going forward? Where are we going forward? Where is inflation? What's the ECB going to do? So the survey expectations came in at 5.5, negative 5.5 versus the previous negative 12.2. So a little bit of a better feel. Then you look at industrial production, as we showed in June, was going to be a bit better, but we see that actually slowing down in July and August when you look at import-export data. But the big piece is going to be the trade balance side. So you can see that trade balances have improved a bit. A lot of that is because of less imports, more exports. But it's going to be more important, instead of looking at the aggregate, in terms of looking at the underlying. So when we look at Germany, just taking that for an example, wholesale price index came in at negative 0.2 versus the estimate versus the previous wholesale price year on year, something similar. But the expectations continue to be negative, less negative in terms of expectations, but it's still on the downward trend. And we actually think it's going to get a bit worse on expectations, because of the problems that are arising on the energy side, where things are getting more expensive. Now you have that unknown on LNG cargoes. And it's not that, they still have enough in storage. It's not that things are going to shut down instantly. It's just this is going to drive up pricing. And Germany is a very important exporting market, is a very big manufacturing market. And then the current situation was expected at negative 63, came in at negative 71.3. So some people are assuming we're at the worst and then it'll get better from here. And now on the manufacturing side, they're correct. We do believe, and as we've said, manufacturing will improve from July. But we think services gets a bit worse. And that is going to weigh on things in general when you look at some of this activity and productivity coming up. France, when you look at CPI, you had CPI accelerate a bit on the CPI month over month, coming in at 0.1. Year on year coming a little bit in line, but a bit trending a bit higher, and unemployment getting a bit worse. So again, France is showing some of that degradation, but again, that re-acceleration in July for inflation is increasing in August. And that's when we look at the ECB, and there's no way that they're going to be able to avoid raising rates again when you look at how low they kept rates for so long. They had negative rates for how many years? Italy CPI coming a bit right in line with expectations. The trade balance continues to be a bit of a back and forth, but the government debt increased again. And that's a bigger issue when you look at the general government debt moving up. They're trying to step in front of it, but that's the issue when you look at ECB raising rates, and their cost of borrowing is going to continue to drift higher because the spreads don't make sense. Germany, yes, their economy on the numbers side is a bit worse than Italy. Italy's closing the gap quickly, but Germany doesn't have the same level of debt that Italy does. And that's when you start to see some of these different weightings. Spain CPI accelerated, came in at 0.2 instead of 0.1. Core came in at 6.2%. So again, you're seeing some of that reacceleration again at the Spanish front. So when you start looking at core inflation, it's settling above 3% next year. That is not something that the ECB wants to see, because if you remember, going back, and we've shown some of these charts, everyone had these big lofty, it's like, oh, well, inflation is going to come up and it's going to come right back down. It's like, no, it's not. And it's because there's been so much liquidity for so long, it's going to be difficult to continue to do that. Now, market expectations are, they're saying that they're still too aggressive. We think that there's going to be more rate hikes, especially in Europe and the ECB. They were the last to do it. They were late to the party when you looked at raising rates, and now we think they're going to have to close that gap. So then when you look at the underlying debt burdens and the underlying loan crisis, the broad credit and the bank loans in general, it's continuing to diminish. You're seeing some of this tightness in terms of what's outstanding, and that's going to continue to tighten overall when you look at what is happening in Europe, how that is impacting things going forward. And again, that's going to eat into not only just the credit growth, but also loans and how those loans are being impacted. And then as we go forward and looking into not only just the loans for companies, but also the consumer. So that's what we have for you on this side. In the next segment, we're going to go much deeper into China and Asia in general, especially with India, and trying to understand all of these different pieces as we pivot over into the Pacific.